Hi, David.
Hey, Hutch, it's good to see you again.
Now, we are starting before the big Fed meeting, but we will show it after. How was the sentiment going in?
You know, people really seem to have a sense that they know what's coming. Jerome Powell pretty clearly signaled that it was going to be 50 basis points back on November 30th. You know, so they'll probably bump up the dot plot a little bit, maybe take up the terminal rate to 5.25 or 5.5. But I think the big thing was the comment about goods inflation coming down. You know, since then, we've just seen a lot of ongoing positives, like there's the Institute for Supply Management showing more downside in prices. Oil's been down, gasoline, diesel, and we've also seen weakness in rents. And so all those things pretty much suggest inflation is easing. A lot of people don't really want to believe it, and they're convinced we're headed for a recession, but that isn't really a sure thing.
So you expect a soft landing?
You know, it's starting to look really like that. Jobless claims are more or less my favorite predictor of the economy and not the yield curve, because the Fed has obviously moved the short end in such a big way. But jobless claims don't show any kind of recession. You have personal income and spending have been very strong. The non-farm payrolls, retail sales have been very strong. You also have junk bond spreads that show very little, sign of a recession coming. And then the transportation sector is actually pushing back to the upside here. So there's not a lot of clear signals that there really is a recession, despite what people say.
Now, you're comparing the current market to 1994 and 1995, which was followed by a huge bull market. Is that a good comparison?
I think in a way it could be. You know, if inflation comes down and there's no recession, you have a soft landing. 1994 was similar because the market was pretty much bad all year. And then as we moved into 1995, the market started rallying as the Fed paused. Negativity back then was also pretty high. But if you look now, it's higher. The American Association of Individual Investors survey has been around only 25% bullish most of this year, which is worse than 1994. So you have similar conditions. The Fed is nearing a pause. The economy might be slowing down a little, but it's still relatively strong, and investors are highly negative. I'm not sure we'll see as much of a rally as 1995, but there are some similarities.
So what does it mean for the big NASDAQ names, in your opinion?
Yeah, I think it's that's one of the issues is a lot of those companies are so big that it might hold back the overall market. And I think we've seen some real structural change in leadership in the last couple of months. You know, that often happens when you come out of a bear market or a correction. The big software names, the big internet names like Microsoft, Alphabet, and Meta, they'll probably inch higher, but they're not likely to lead again. We had a bubble in online advertising in 2021, a lot of investment in cloud computing, and that probably is not going to be coming back right away. And the money now seems to be moving toward the cyclical names like the industrials and the financials. You know, these stand to benefit from the economy improving after the Fed pauses. And your airlines are also showing a lot of relative strength. And then if you look inside of the technology sector, you know, we're really seeing the strength more in the semiconductor space, which is also more cyclical. You know, from my view, it's all about the economically sensitive names. The two blue chips that I'm watching the most are Boeing and Goldman Sachs, which is an industrial and a financial. And then I would also note that some of the big pharma names like Merck have broken out. And, you know, if we get a pullback in those might be places where people also look for some opportunities.
Thank you, David. Thank you for your help this year.
Thank you, Hutch. You too. Hope you have a happy new year.
See you next year.